Another name you like is a financial technology firm, Fiserv. When
Yeah.
we look at this one, it missed on its last earnings report. What do you see in that stock that makes you a little bit more confident than others?
Yeah, we are long-term investors, and we don't like to see any miss. But if it's explained well, we're okay with that. Fiserv is a leader in electronic payments. When you pay your bills with your bank online, you're probably, depending on your bank, you may be using Fiserv. Thereabout, when you use a debit card, you may be affiliating with Fiserv. So the electronic payments business is going to do nothing but grow. They generate substantial amounts of free cash flow. They ought to have $1 billion of free cash flow this year, which they've been using to make acquisitions and buy their own shares back in.
Why do they generate so much free cash flow?
They don't have a lot of capital expenditures.
Yeah.
They have high net income, not a fair depreciation, and not a lot of capital expenditures.
Another one, I guess, somewhat in the data processing area is in the HR field, Paychecks.
Yeah.
Now, the shares of this one struggled this year. Analysts more negative on this stock. Are you expecting a turnaround here?
Well, Paychecks is a play, as is ADP, the larger competitor, in an improving employment market. And we've seen it a little bit this year, but we haven't seen it consistently take off to generate higher than expected earnings. They are also a play on rising interest rates because they have a lot of cash that they hold and reinvest. So, you know, Paychecks is a play on an improving U.S. economy. Frankly, it's occurring a little bit slower than we'd like to see, but again, you know, double-digit earnings, or high single-digit earnings growth, good growth company. One, and I should mention this about all these stocks, we're concerned about the market. They all have betas below the market's beta, so they're growth companies with low volatility.
Finally, Verizon. Stock's taking a tumble.
Yeah.
What's happening with Verizon that you see some interest in?
Well, what drew us to Verizon was the pop in earnings that is happening because of the acquisition of the rest of Verizon Wireless that it didn't own from Vodafone. So that's going to give them good earnings growth this year, good earnings growth next year. What we didn't see coming is the whole non-merger between T-Mobile and Sprint. We thought that was going to create a third competitor, so there'd be a three-ring oligopoly and more rational pricing. However, that seems to have fallen apart, leading to fears of irrational pricing there. But again, we're a little concerned about the market. Verizon's 4% yield, low beta, decent earnings growth. You know, think it's going to be a reasonable. We think it's going to be a reasonable stock for the next year or so going forward.